Today, that is October 16th, is Global Ethics Day. And ethics in our day-to-day lives form the core base for any civilized society. Without ethics, no progress can be sustainable, however fast and however high it might be. Separately, October 14 to 20 is also being celebrated as World Investor Week. And hence, today's webinar, combining all these things together, will cover and has aptly been titled Ethics, Happiness, and Wealth Creation. To share thoughts on all these topics, we have storied speakers, well-known speakers today for all of you. None of those speakers, very frankly, need an introduction. So to start with, we will hear thoughts from Mr. Navneet Munot, who is MD and CEO of HDFC Mutual Fund, of course, a CFA himself. After that, we will have Director NISM, Mr. Sashi Krishnan, addressing you. And then I will ask Srinivas Kunte to come in, who works with HDFC Mutual Fund and who is on the board of CFA Society, to take over the proceedings and introduce our two other speakers, Mr. Amit Chakrabarti and Mr. Sanjay Parekh. Welcome all of you once again. Over to you, Navneet.
Thank you, Kunj, and good to have Shashi, Sanjay, Amit, and of course Srinivas, who's put this all together. So good to be part of this. And I'm so delighted to be part of a conversation which is on ethics, happiness, and wealth creation. These are precisely the things that not only shapes our professional lives, but I would say also lay the very foundation for fulfilling our personal journeys, our pursuit of happiness. It's actually quite a special day, Kunj, as you mentioned, to celebrate ethics. It's the World Ethics Day, a global initiative that was started by the Carnegie Council. I think it's the 11th year or so, and it's celebrated in over 100 countries. A day that aims to raise awareness of our most critical issues facing society. And ethics, of course, in CFA Society and in NISM and capital markets, we pay a lot of attention, but it's not confined to one nation or one profession. It is universal, it's essential, and it's I would say, enduring. Whenever I have any opportunity to discuss about ethics, I always quote a learned person who said that when I ask, like, what is the definition of ethics or integrity, and I say, quote someone that integrity is doing the right thing even when no one is watching. Integrity is doing the right thing even when no one is watching. It must be part of who we are. It's not about compliance or regulation or following the rules or any code of conduct, internal or external. It's about our value system. It's our belief. It reflects who we are. And talking about who we are, in Indian culture, ethics has always been woven into the fabric of our ethos. I mean, for centuries, we have embodied the basic moral tenet as part of Paramarth. Paramarth is the pursuit of the greater good, selfless service, doing good to others without expecting anything in return. I mean, that's been our culture. And even in the hardest of times, we have learned to behave ethically as a guiding principle in our lives. You go back to Mahabharata, you go back to Ramayana, and they are all filled with stories that remind us the power of ethics, whether it's the Arjuna's moral dilemma on the battlefield or the Lord Ram's unshakable commitment to upright behavior. And I'm putting this because we just celebrated Dashara and all of that. And even beyond these epics, I mean, our culture has deep roots in ethical values. We are the ones who have always believed in Asatoma Sadgamaya, Tamsoma Jyotirgamaya, Mrityorma Amritgamaya. We are a society which is always seeking untruth to truth. Lord, move me from darkness to light and from mortality to immortality. And if we go back since time immemorial, whether the Buddha who said, Mahavira who said, live and let live, or more recently, Mahatma Gandhi and his life is an example of selflessness, a life that brought freedom to millions. We always believed in Bahujan Hitai, Bahujan Sukhai, and that's the key to happiness, and that's what I thought I'll highlight. Recently, it was, of course, a sad day that Mr. Ratan Tata passed away, but it also was an opportunity for all of us to celebrate a great life. I mean, the governance system, the ethical standards, working for the society, the ethos and values of the Tata Group. Looking at the title of today's program, I was very happy to see the title, as I mentioned earlier, connecting ethics with wealth creation and happiness. So, what's the connection? And the connection is the answer lies within our biology. Our brains consume most of our energy, I think something like 25% or so. And much of that energy is often spent worrying and anticipating negative outcomes. And we know living in markets day to day, living an ethical life frees us from this burden of rumination. And when we align with ethical principles, we kind of release ourselves from the anxiety of self doubt. We become less concerned with external validation and more focused on fulfilling our mental clarity to allow me to think expansively, and this can unlock limitless possibilities. At SDFC AMC, we have a mission to be the wealth creator for every Indian. And we did some, interesting internal survey, and we asked our colleagues across the country, and then Srinivas worked with me on that, what they felt about the impact of ethics in professional and personal lives. And the top three words, if I remember correctly, that appeared most frequently in the responses were peace, happiness, mind. And this highlights what ethics fundamentally brings us. It's a peaceful and a happy mind. It aligns with the ancient belief that I talked about earlier, that ethical living leads to inner tranquility, which is essential for sustainable wealth creation. When I meet youngsters and in our CFS society, we always talk about, we put like ethics and the integrity at the center of everything we do. Always quote Warren Buffett, who said that when hiring, I always look for three things: intelligence, energy, and integrity. But he emphasizes that if integrity is missing, the other two won't even matter. And that's important because we need competence, we need capability, we need comprehension in whichever field we are in. Of course, in financial services, where most of us an opportunity to work. But what is really required for success in the long run is actually courage, conviction, and character. And character is like the most important. Our profession really demand, as I said, very high level of capability, competence, and comprehension. But what's really the most important is a character that ensures we uphold integrity, we uphold trust, which is the true foundation of success in our world. I really want to express my gratitude to everyone who has joined here today. I feel this topic deserves a lot more of the spotlight, and I hope we continue with a whole series on this. Thank you to NISM, Shashi, you and the team, CFA Society, Amit, Sanjay, Srinivas, everybody who's here, and for continuously bringing the importance of ethics in our industry to light. As I mentioned earlier, ethics or being ethical is not just about compliance or following rules. It's not. It's about liberating ourselves from unnecessary burdens and opening the doors to happiness, peace, and wealth. And I'll just kind of end on, and if I remember correctly, and I hope that I put it right, that ethics is knowing the difference between what you have a right to do and what is right to do. Yeah, what you have a right to do and what is right to do. So on that note, thank you again, and I hope we all, I mean, you all enjoy the rest of this important session. Thank you so much.
Thanks, Navneet, for highlighting the importance of ethics. I now invite Mr. Sashi Krishnan, Director NISM, to guide the audience.
Thanks, Kunj. And thank you very much, Navneet, for that very, very sort of engaging keynote address. I just want to relate two stories that sort of somewhere, bring all these three things into connect. That is ethics, happiness, and wealth creation. So way back, in close to around 99, 2000, I invested into the bonds of a company called Nishkalp. Now, not many of you may know about this, but Nishkalp was a wholly owned subsidiary of Tata Finance Limited. And it was run by one of the stars of the Tata firmament at that point of time, Dilip Pense. And I don't know how many of you have heard of him, but Pense is unfortunately passed on and is no longer with us. And, we had bonds of Niskalp, and these bonds of Niskalp had a letter of comfort from Tata Sons. Unfortunately, what had happened is there were a lot of, incorrect practices that were happening in, Tata Finance and Niskalp. And what was happening is that money was being siphoned out of Tata Finance into Niskalp. And a lot of this money got invested at the top of the dot-com boom into a lot of these dot-com stocks like, Global Telesystems, HFCL, and so on. And when the bust happened, Niskalp defaulted, right? And here was a company that we had invested into. We had bought those bonds primarily because we had a letter of comfort from Tata Sons, which said that, in case something happens, we would get, we take recourse to Tata Sons. But it was a very, very, let me say, legally loose arrangement where, Tata Sons did not have the obligation to come and meet up with what we wanted to, if there was a default. And nobody actually even expected a default. I remember, somewhere in 2002, when this default happened, at the VSNL AGM, Ratan Tata stepped up to the stage to clear the air on this. And he says that we at Tata Sons will put in 425 crores into Tata Finance and Niskalp, right? So that no stakeholder would suffer a loss. And he went on to say that we have put in the money because we have the moral responsibility to meet this obligation. Lucky for me as a fund manager, I got my money back, but I still remember very vividly that if at all there was something that reminded me about ethics and wealth creation, it was this fundamental concept of the moral responsibility that every business manager has to meet his obligations. The second story that comes to mind, again from the Tata stable, and I thought I'd talk about Tatas because, recently we lost Ratan Tata to the Almighty. And, this brought back memories, especially around ethics and wealth creation. And, many of you in the market will remember that TCS went public only in 2004. So it is actually just about 2 decades that TCS has been a listed company on the stock exchanges. At that point of time, Tata Sons diluted, if I'm not mistaken, something like 14% of their stake in TCS. That's around 5.5 crore shares or so, right? And I remember at that point of time that they priced the share at 850 rupees. Right. Just imagine that the earnings per share of Tata TCS at that point of time was something like 42 rupees. So it was actually priced at a PE of something like 20 times. Look at its competitors. Its competitors at that point of time, for example, I think Infosys was quoting at 25 times 1 year forward PE. Wipro was quoting at 25 times 1 year forward PE. Its global peers, people like sort of Amazon and Cisco, were quoting at something like, much higher levels than that, right? But at that point of time, when Ratan Tata was asked, why are you pricing that at 850 rupees, which is significantly cheaper than the market? He says that the ethically right behavior is to leave something on the table for all the shareholders who are coming into this company. But I think the story does not end out here because this is anecdotal. So, I do not know. I participated in the TCS issue. We invested into that company. We stayed invested in that company, for a very, very long time. But anecdotally, and this is something I've read in the newspapers and I've heard from people who worked in the, in the Tata ecosystem. It appears that, this idea of listing TCS on the NASDAQ, went back to 1999 itself. And it appears that at that point of time, one of the very senior advisors in the Tata group actually had gone up to Ratan Tata and submitted him a note telling him that, this was the time for them, in the dot-com bubble time, for us to list on the on the Nasdaq, right? And if TCS had, diluted even a very, very small portion of their shares, on the Nasdaq at the valuations that, IT companies commanded at that time. And what were those kind of valuations? A company like Amazon had a PE of something like 2000. I mean, unimaginable. It was actually almost a loss-making company at that point of time. Even Cisco had a PE of something like 150. If TCS had actually decided that it wanted to list on the Nasdaq at these kind of prices, they could have actually bought back the public shareholdings of all the listed Tata companies with the kind of money that they raised in the market. And this is anecdote again. Ratan Tata, it appears at that point of time, seemed to did go and tell people that this is something that he would not do, because he said, if I did this, I would be taking unfair advantage of a short-term bubble to mislead investors about the true value of TCS. And this was in 1999. So, the real life connection of ethics and what we do today in the market, right, is very, very real. And there are, I think people who have exhibited ethical behavior have helped investors create long-term wealth for themselves. And with this long-term wealth, comes happiness. So, welcome to this webinar which we are doing on World Ethics Day. And, I hope all of us will learn that, it is only ethical behavior that will stand us in good stead in the long run. Back to you, Kunj.
Thank you, Shashi. Those anecdotes, I'm sure, would have been of quite an interest to our audience and give them real life examples into the practice of ethics. Thank you once again. Now over to you, Srinivas, to take over the proceedings. Introduce yourself also briefly, and then introduce our other two speakers and the topics that they'll be speaking, Amit Chakravarti as well as Sanjay Parekh. Over to you.
Right. Thank you. Thank you very much, Kunj. I hope I am audible.
Yes.
Thank you very much, Sashi sir. That was a very insightful and a very practical set of anecdotes that will stay with the audience, I'm sure, forever, and for me as well. It shows again, that ethics helps, not just the individuals that are going to practice it, but also the biggest corporates that are functioning in India. We've got two speakers now. One is Mr. Amit Chakravarti, who's a friend from my CFA Institute days. Amit Chakravarti is a director for partnerships, institutional partnerships at CFA Institutes. He has taken many seminars on ethics. He speaks very passionately on the subject. He also does an ethics game show. But today he's going to speak for about 30 minutes, and he's going to give us a good look at how ethics can play in practice with some practical case studies. Over to you, Amit.
Thank you so much, Srinivas, and to the entire NISM and CFA Society India team. So, as Srinivas mentioned, typically I like to run this as a workshop, which is more interactive. The idea is to practice ways and means of identifying ethical dilemmas and then hopefully addressing it in the best possible manner. So today it's going to be a monologue. So I hope to still keep it interesting. Let me share my screen. Second. All right. Is my screen visible, Srinivas? Or anyone else?
Yes, it is. Yes.
Okay, great. So, Navneet talked about, that today is Global Ethics Day and it's the 11th year it's been celebrated. The theme for this year is Ethics Empowered and using ethics to build a better world. And that's exactly the topic of this session that I'm going to deliver today. The hope and goal is that both the society at large and the financial industry thrives when ethics is prioritized by everyone, all stakeholders concerned, right? Very briefly, before I go into my presentation about CFA Institute. So it's a not-for-profit organization, and our mission is to lead the investment profession globally by promoting the highest standards of ethics, education, and professional excellence for the ultimate benefit of society. So ethics, as you can see, comes number one at the beginning, and that's front and central to everything that we do at CFA Institute and all of the sister societies across the world. So as I mentioned, I like to run it as a workshop, which is more interactive. Typically, so today I'm not be using the case studies that I typically use. But overall, what are the goals of a workshop like this? Number one, it is to encourage one to become more conscious about one's thoughts and behavior so that one is more likely to notice and act upon ethical issues before they become a problem, right? So just to be more conscious about one's surroundings and thoughts and behavior. Number two, to recognize that ethical dilemmas are a normal and predictable part of most days, most jobs and day-to-day lives, right? It's normal. It's not something abnormal. So we need to be aware, and we should expect that this kind of ethical dilemmas to happen in our lives. And last but not the least, to discuss and practice approaches for dealing with ethical dilemmas as and when we encounter them, right? The fundamental basis here is that we believe that all human beings have got very strong core values which they apply to their personal lives. But then when we go into our work environments, when we go to our professional lives, we might be put into situations where some of these core values become secondary and we get more influenced by what's happening around us, particularly in our professional lives, right? And the hope and goal is that that there should be more and more alignment between how we act in our personal lives and how we behave in our professional lives, right? As Navneet and Sasi mentioned, ethics and happiness goes hand in hand, and if we do that, then all stakeholders, individuals, companies, society, everybody would be happy, be prosperous, be well to do as well. So the first one, I like to start with this quote by a guy called Aldo Leopold. Navneet already mentioned this. Ethical behavior is doing the right thing when no one else is watching, even when doing the wrong thing is legal. So this was said in the context of when a lot of Europeans were settling down in the United States of America, and the land was free for all. So anyone could come in and go to any particular part of the US and then grab land and call it their own, right? Disregarding the rights of the local population, the Red Indians, etc. So this was the context when Aldo Leopold said it. Ethical behavior is doing the right thing when no one else is watching, even when doing the wrong thing is legal. The other quote I like to start my presentation with is from Abraham Lincoln. It says that when I do good, I feel good. And when I do bad, I feel bad. That's my religion, right? Again, something that both Navneet and Sasi talked about as well. So let me start with this first concept called situational versus dispositional, right? So situational means the kind of scenario that we are put in our lives, in our day-to-day lives. And disposition is what our core strong values are, what we are as an individual, as a person, right? So some studies have shown that situational influences have more to do with a person's ethical behavior than a person's character, right? So situation drives a person's behavior rather than the character of the person. Under the right conditions, good people can be induced, seduced, and initiated to act unethically. Okay, and I'm sure all of us have been in scenarios like this and hopefully found the right way to address it. So what are some of the situational influences that we are talking about? Obedience to authority. My boss or manager asked me to do something. So how can I say no to my boss, right? Conformity with others, and I'll quickly do a YouTube video as well around group conformity. Since everyone else is doing it, maybe it's the right thing to do. Maybe everyone else is right and I could be wrong. Following group decisions, right? So I'm a team player. How can I go against a group, right? Incrementalism, which I think is very, very interesting, right? It's a gradual shift in towards unethical behavior. Some small steps, maybe taking a stapler from the office, maybe doing some photocopies in the office, maybe taking a pen or paper from the office, right? This slowly one starts getting towards more and more unethical behavior over a period of time. Overconfidence in one's ability to act appropriately. Again, a very interesting one. I'm an ethical person. I'm a righteous person. I mean, I will not do anything unethical. So that overconfidence sometimes blindsides one into not being able to identify an unethical environment, right? And last but not the least, framing and responding to incentives. A lot of our salaries or bonuses are tied to how we deliver targets and all. So it's very easy to frame and respond to incentives, right? So these are some of the situations that all of us might find ourselves in our day-to-day lives. Let me quickly play, it's a 2-minute video, but I'm sure you'll find it interesting. Again, typically we discuss this once the video is run, but we'll not have the discussion today. Just listen to it and we'll talk a little bit more about it.
The Ash experiment is one of psychology's oldest and most popular pieces of research. A volunteer is told that he's taking part in a visual perception test. What he doesn't know is that the other participants are actors, and he's the only person taking part in the real test, which is actually about group conformity.
Please begin. The experiment you will be taking part in today involves the perception of line length. Your task will be simply to look at the line here on the left and indicate which of the 3 lines on the right is equal to it in length. So, for example, if you...
The actors have been told to match the wrong lines. The volunteer will be monitored to see if he gives the correct answer or if he goes along with the opinion of the group and gives the wrong answer. In the first test, the correct answer is 2.
1. 1. 1.
Two.
1. Once again, the correct answer is 2.
3. 3. 3. 3.
3.
The Ash experiment has been repeated many times, and the results have been supported again and again. We will conform to the group. Again, we're very social creatures. We're very much aware of what the people around us think. We want to be liked. We don't want to be seen to rock the boat, so we will go along with the group. Even if we don't believe what people are saying, we'll still go along.
1. 1. 1.
1. Group dynamics is one of the most powerful forces in human psychology.
1. 1.
So as you can see, this was this experiment, by the way, was done in the 1950s, and these are scenarios that we still see today, which means some of these things have not been addressed, and it's how hard or difficult it is to look at stuff like this, right? So the whole experiment was about group conformity, where one person was and not an actor as an original person. Everybody else was giving a wrong answer, and eventually, as they kept walking together, the person stopped thinking and about what's right and wrong and just followed the group, perception of what is right or wrong, right? So it is obedience to authority, obedience to a group is a very, very powerful thing. Sometimes it's not even explicit and it just happens, right? People just don't want to go against the group perspective. So sometimes one just can't trust one's gut instinct. So one has to be very systematic so that one is aware of the pitfalls of group conformity and thereby be able to address it in the right manner as well. So what's the takeaway from this? We often make unethical decisions not because we are bad people, but because psychological biases, social and organizational factors, and situational influences affect our decision making. These biases, factors, and influences lead to weaknesses in how we process information and make decisions, which can lead to unethical behavior. So moving on, I think again Navneet talked about the law and ethics, all right, the way I call it compliance and ethics, right? So compliance is what's the difference between these two? So compliance is something that you must. That's a law of the land, right? It's something there's no debate, argument. It is the law. One has to follow it. Period. Right? Are you permitted to do something? Is what compliance is about. Ethics, on the other hand, is stuff that you should do. Okay, it is more about just because you can, should I do it or not, right? Is it consistent with my organization's value and mission, right? The larger good. I mean, Sasi spoke about TCS, like, not listing in the US or leaving some value on the table, right? So that's more around ethics rather than compliance. Moving on, a lot of India is a young country, and we got a very young demographic, which means more and more people would be entering the job market, starting their careers, right? So this is, and I'm sure a lot of you here on this in this webinar are young as well, right? Or just starting out or in the mid-level careers of yours. So this is all about around ethics and your careers. So ethics can be dangerous to your career because you may be called upon to do things that eventually turn out to be unethical or illegal. A Harvard University study found that many graduates received explicit instructions from their middle manager bosses or felt strong organization level pressures to do things that they believed were sleazy, unethical, or sometimes plain illegal. Similarly, a Columbia University study found that 40% of graduates had been rewarded for taking some action they considered to be ethically troubling. And 31% of those who refused to act in ways they considered to be unethical believed that they were penalized for their choice, compared to less than 20% who felt they had been rewarded. So these are three examples of people who have been in the newspaper for all the wrong reasons. Fabrice Touré, a 29-year-old guy, he was found liable on 6 of 7 counts for defrauding investors. So this is around the global financial crisis that happened in 2007-8. Very, very interesting deal, so read about it. So on his role in the Abacus 2007 AC1 security deal, Fabrice said that I was a big team player. If there's something wrong with this transaction, wouldn't people have told me? Likewise, Tom Hayes, 31 years old, he was the only trader who was cited by name in the LIBOR investigation on manipulating LIBOR. Who was I to question what they were doing? I thought it was weird, but that's how I did it. Within a few months, based on practices at the bank and feedback from his bosses, Mr. Hayes considered this part of his job. Kweku Adebolu, 32 years old, is a trader who lost $2.2 billion. He told the jury at his trial, senior managers were aware of my actions and encouraged me to take risk. Circumventing the bank's rules was common practice, and I only got into trouble because I lost money. Now, if we look at these three people that I noticed, Fabrice, Tom, and Kweku, right? They're all 29, 30, 31-year-old, right? So young is somebody who's probably worked in the industry for 5-7 years, right? That's is it possible that these guys would have done these things by themselves without having orders from their bosses or without having explicit approval of their bosses, right? The probable answer is no. But the only people who got into trouble are these guys, not their senior bosses, right? So as young career professionals, we all need to be aware that when things go right, maybe now nobody will notice, maybe nobody will come after us. But when things go wrong, the people who can get into trouble are these young people who are actually taking the actions, not the senior-most bosses who never got fined or penalized or jailed because of stuff like this, at least in these three examples. So this is what Robert Prentice said, the unethical actions of infamous wrongdoers who have populated the crime sections of financial papers do not prove they're evil people. Instead, they illustrate that the circumstances in which we find ourselves in often, not always, have more to do with the decisions we make and actions we take than our basic character traits. Right? Again, goes back to the whole thing about situational versus dispositional, right? One might have very strong values, but when we're put in situations where we are not in control of, how do we behave, how do we act, and what we should or should not do. So what are some of the, fundamental ethical principles, right? Client interest always comes first. If I might be working in a company, my company is paying my salary, but as a professional, I should always look out for the client interest. Maintain independence and objectivity. How could my independence be compromised? Or objectivity might be compromised. The group conformity thing we spoke about, following orders, bosses' order, etc., right? Avoid and manage conflicts of interest. If there's any conflict of interest, better to stay away from it, or at least disclose it immediately and fully. Always do full and fair disclosure. Preserve confidentiality. Like, if I'm walking somewhere, it's my duty, it's my job to retain that confidentiality of all the information I'm doing it. Fair dealing. I might have 20 different clients, some of them small, some of them big, but I need to treat all of my clients equally and deal with them equally and fairly, not prioritize one client because I'm going to earn more money out of that person versus another one. Reasonable care and prudent judgment, right? So not using gut instinct, not using speculation, but doing proper research, doing prudent judgment around it is very, very critical. Prohibition against using material non-public information, something that we all know about and are aware of. So moving on, there's this very interesting concept called rationalization, right? This allows us to avoid or reduce the negative impact that accompanies performing any unethical act. It's used to justify behavior that is inconsistent with our own opinions of ourselves. And rationalization can change our perception of a situation or social environment to defend or excuse our behavior. I love this thing, a quote from Lee Brackett from The Long Tomorrow. There's never been an act done since the beginning of mankind, from a kid stealing candy, we all have done it, to a dictator committing genocide, that the person doing it didn't think he or she was fully justified. That's a mental trick called rationalizing, and it's done the human race more harm than anything else one can name, right? So again, we spoke about incrementalism, we spoke about group conformity, team decisions. Rationalizing is a very, very interesting. How do we kind of rationalize in our own hand? Whatever act we have done, how do we rationalize it? And that kind of leads to a lot of unethical behavior over a period of time. So what are some of the ways we rationalize our unethical behavior? Everybody else does it, so it must be okay. That's the way they do it at Formex. Everybody in my company does it, so I'm sure that's fine. If I do not do it, someone else will. That's the way it's always been done. Easiest way to rationalize some behavior. It doesn't really hurt anyone. Just because it doesn't hurt anyone doesn't make it right. That's what we need to remember. It's not a big deal. It's a very, very tiny matter, right? It's not a big deal. Again, goes back to that incrementalism thing that we spoke about. It's not my responsibility. Somebody else is doing it. I'm not part of it. So it's not my responsibility to point it out, to talk about it, to discuss it, etc. Right? I want to be a team player. I want to be loyal. Again, these are some ways that we rationalize our unethical behavior. So at CFA Institute, we have this code called the CFA Institute Code of Ethics and Standards of Professional Conduct. So every CFA charter holder, Sanjay and Srinivas here, Navneet, all of them are CFA charter holders. Every year when they renew their membership, they have to sign this code. So unlike doctors who sign the Hippocratic Oath only once in their life, CFA charters have to sign this every year, right? So this is nothing but a set of seven sets of principles. It talks about professionalism, talks about integrity of capital markets, duties to clients, duties to employers, investment analysis, recommendations and actions, conflicts of interest, and responsibility as CFA Institute members and candidates, right? So, all of these principles are very, very, relevant and pertinent to every single person in this world, whether it's he or she is a CFA charter holder or not, right? And I strongly encourage you to, Google Standards of Practice Handbook, CFA Institute, and go through it. There's a short version, which is just 2-pager, and there's a long version. At least the short version is something that everybody should go through. It's very, very interesting. So moving on. So now we spoke about some of the situational influences. We talked about rationalization. We talked about ethical, fundamental ethical principles. We talk about the CFA Institute Code of Conduct as well, right? Now, here's a framework that we have put together in, how do we address an ethical dilemma as and when we came across it in our lives, right? So, okay, we are now aware of all the different ethical dilemmas that we can be faced with in our lives, right? So what do we do? once we face this, right? So we came up with this 4-step framework at CF Institute, which we strongly encourage anyone and everyone, no matter what kind of job we do, to follow and look at, right? The first step in this process is identify, is there really an ethical dilemma? What exactly is the ethical dilemma? To whom do you owe a duty to in this particular scenario? What are the various facts and information that will help me make an informed decision on dealing with this ethical dilemma? Are there any conflicts of interest? The next step would be to consider. Okay, so what kind of situational influences might be clouding my mind, in terms of making a decision, right? What are some of the various actions that I can be thinking about to kind of address this particular ethical dilemma? Can I brainstorm with some people to come up with 5, 6 different ways to address this ethical dilemma, right? Do I need to talk to someone else or to gain some additional perspective, right? So the first one, which is think, I identified that dilemma, I figure out where I owe a duty to, what are the different facts and matters out of it. The second step, which is consider, I look at what are the influences that might bias my decision, what are the various action items that is possible and all, right? The third step is to act, right? Now that we have all the information, we have figured out different ways to address this, make a decision, what's the best possible course of action for this particular ethical dilemma. And if by any chance, if you're not able to come out with a proper action, then can we escalate to a higher authority, right? Can we escalate to someone else who might help me in making the right decision, right? And last but not least is reflect. What did I learn from dealing with this ethical dilemma, right? What are some of the strengths and weaknesses that I've identified in the various scenarios that I've considered, right? So the next time when I'm faced with something similar, I know exactly how to behave and act. I would leave you with this thought from with this quote from Warren Buffett. Whenever we are doing whenever we are acting on a particular matter, Warren Buffett said, I want employees to ask themselves whether they're willing to have any contemplated act appear the next day on the front page of the local paper, to be read by their spouses, children, and friends, with the reporting done by an informed and critical reporter. So very credible reporter talking about your particular act in the local newspaper to be read by your spouse, your parents, your children. Now, if the answer to this question is yes, I'll be proud of it. My children will learn something from this. They'll they'll kind of do something similar in their lives. Then maybe the act is an ethical one. But if the answer is no, I don't want anyone to know about this act, then maybe it needs some reconsideration. Maybe there's some unethical element creeping in, and I need to figure out what the best way to deal with it is. So with that, I'll stop and hand it back to Srinivas.
Thank you, Amit, for such an insightful presentation on ethics, and that quote from Warren Buffett, which is not dissimilar to the sentiment that Valmiki exhibited in it's a famous story from Ramayana, when Valmiki, the sage, he's become a sage, but before he became the sage, he was asked. He used to waylay people and do thefts, and he asked his wife and children, "Would you be party to this? Because I am doing this all for you." They said, "No, we won't be party to this. Stop sinning." But on that note, let's get to the next speaker, Sanjay, and I'm sure every one of you is waiting to listen to some of the thoughts that Sanjay has to share on wealth creation and how do you build wealth. Over to you, Sanjay. Sanjay is also a fellow director on the CFA Society India board. He is a founder of Equizen. He's got huge amount of experience in the industry and knows the wealth space inside out. Over to you, Sanjay.
Thank you, Srinivas. Can you confirm that you can hear me and also see my presentation?
Yes, we can. So there was a participant who said, you can move your bar at the top so that the screen is visible, which you have probably done.
Okay, so I think this is better, right?
Yeah. Yeah, we are good. Thank you.
Yeah, how do I do this? The slides are not going ahead. I don't know what is the problem. Okay, great. Hi, good evening, everyone. I think those were very insightful sessions from Navneet, Amit, and Shashi. And while they were taking their sessions, I was also thinking about something that happened just recently with me. My daughter is studying in the US, and she wrote to all of us on our family WhatsApp group, that she had just made a bookshelf with her own hands, and it gave her a lot of satisfaction doing that. And I responded to her saying that you need to do these kind of things in order to get happiness. And it is so very well related to ethics as well as doing the right things. Everybody has been talking a lot about Ratan Tata and what a life he has led, and the fact that so many people has written about him. And there were some news reports that there was the Navratri festivities were happening, and when his death was announced, there was a spontaneous stoppage of those activities to pay homage to him. So one needs to really figure out what are the things that will lead to your own happiness. Of course, doing the right things, helping others are some of the things that one can inbuild in our day-to-day lives, to ensure that we all have a good night's sleep. We have a peaceful sleep. We are not anxious. We are not worried. We are not disliked by people. We are liked by people. When we come into the room, there's a smile on everybody's faces. They like to see us. So we can do all of that. And the other thing, of course, is if we have a comfortable amount of wealth to take care of our needs, if not the luxury. So what I'm going to talk about is what are the steps that we need to do to build wealth, and the beach is also a significant source of happiness for many people all across the world. So with that, let me take you to the next slide. So one is, when you talk about financial literacy, this is something that is measured across the world. And if you need to build wealth, then you need to really understand what financial literacy is all about. And it is a critical life skill which is essential for the financial well-being of individuals. But what does it include? It, of course, includes knowledge, understanding, awareness, skills, attitudes, and behaviors as to how one has to manage one's money, as well as how one should be able to manage their risk. So A, it should enable you to do the right things, and B, it should stop you from doing the wrong things that will lead to either poor financial decision making in terms of losses of your wealth, or in terms of having high amounts of debt that you are not able to repay. So once financial literacy was looked at across the world, and there are some surveys done by OECD, what is found is that this is a skill which is not really widely prevalent amongst everybody. And these are some of the statistics from the last financial literacy survey. Only 34% of the global population is considered to be financially literate. And one can really ask that, what is the kind of questions that are asked? So simple questions like, if I were to give you 100 rupees at 10% per annum, what is the money that I will get back after 3 years? If 10% is to be compounded annually. Would it make sense to invest all your savings in the shares of your employer? So these kind of questions were asked, and you can see from the answers that only 34% globally were able to give the right answers, whereas even in the US, which is considered a developed country, that percentage was not very high. It was just 37%. Of course, this survey was not really done in India, but you can well imagine that we as well as the other emerging markets would probably be even lower on these matrices. The other findings were that most people are not able to plan their expenses and their savings and their investments. So 61% of the adults live from salary to salary. More than 50% of the adults do not have funds for emergency purposes. And only 29% of the adults do not worry about where their next meal is going to come from, right? So these are the findings of the survey. And why this is important is because of inflation. If you can see the table on the right side, you can see that if your annual expenditure is around 5 lakhs per annum today, and if you are doing if the inflation in our country is going at 5% per annum or 7% per annum, then after 10 years, the amount that you would require to spend just to maintain your standard of living will go to almost more than double at 5% to 10 lakhs 40,000. And if the inflation rate is even higher, it's going to go to almost 14 lakhs. Maybe some of you can tell me, what do you think is the inflation rate that is prevalent in India today? Can you write in the chat box? Okay, people are answering 5.5 to 6%. That's right. The RBI's aim is to control inflation and keep it around 4%. And let me also tell you some stories that, when I was a kid, my father had purchased a house in the 1980s and in the 1990s. And I remember that he used to pay an interest rate of almost 18% per annum. What is the interest rate on a housing loan today? Abir, you're absolutely right. That is, RBI's target is to keep inflation between 2 to 6%. Yes, housing loan rates are between 8 to 10%, depending on what your CIBIL score would be, what is the amount of loan you need. But that's what it tells you, right? That inflation in India is still 5 to 7%. But what it really does is it really reduces the value of your savings over a period of time. If you can buy the certain amount of goods and services at 5 lakhs today, after 15 years at a 5% inflation, the value that you will need to buy the same amount of goods and services is going to be almost double. And imagine if you are no longer working, you no longer have a salary which is increasing at 8 to 15% a year, how difficult it will be to have a normal standard of living. Okay, let's go back. So this has been the inflation in India over the last few years. As you can see, it keeps fluctuating. In COVID times during 2020, it went up a bit, and it will keep fluctuating, but it's going to remain within the 3 to 5% range. And it is important that we do our investments in a manner that will help us protect the real value of our savings. So let's now quickly talk about investing. If our goal is that we want to beat inflation over a long period of time, how should we really approach where to invest our assets? Well, investing will really depend on a lot of things, but these are some of the core things that you need to consider. So the first thing would be, what is your investment objective? If you want to invest your savings for the short term, that is, you have an expenditure coming up in 3 months' time, in 6 months' time, and you want to save for that, then where you will invest will really be driven by that. You cannot be investing in a volatile and a risky asset, but you want something which is more guaranteed, like a fixed deposit or a debt mutual fund, which will protect your capital and give you a return which is just above inflation, right? Kshitij, you're absolutely right. For a short period of time, liquid and money market funds or FDs are the right assets to invest in. The other thing that you need to consider is what is the return that you need. So let's say you want to buy a house after 5 years of time, and you have certain amount in mind that, okay, I need maybe 50 lakhs to buy this house, and I have 25 lakhs today, and I can maybe invest some more amount every year. Then you need to figure out that what is the rate of return you need to reach that goal of 50 lakhs. If the rate of return is, let's say, 11%, then based on that rate of return, you can choose what you want to invest in. Maybe a hybrid fund may do the trick, or a mix of debt and equity may do the trick. But if you need a return of 14%, then you will have to go for a 100% equity portfolio. But if you just need a 5% return, then keeping your entire investments in debt will also serve your requirement. So understanding what returns you need will actually also drive where you will invest your funds, right? And that really, what returns you need will be driven by what is the amount that you can save, what is the amount you can invest, and what is the amount that you need and after what time period. So these are the factors that you need to figure out. So you need to know, okay, I need an amount X after 10 years, and I can invest A, B, C, D, E amounts every year. And then the rate of return becomes like the end result of this equation, and which will then drive where you will invest in your this thing. So once you have figured out what is the return that you need, you also need to understand that what is your ability and willingness to take risk. Now, these are two different concepts. Ability is really driven by your age. It is driven by your income. It is driven by your wealth status. Okay, so if you are younger of age, if you are high income, if you are wealthy, then your ability to take risk is a little bit higher, right? But if you are spending all your money today, you are not able to save anything, then your ability to take risk is lower. So this is what determines your ability to take risk. However, the willingness to take risk is also equally important. So you may have the ability to take risk. You may be a very wealthy person. Okay, you're not really dependent on your wealth to for your day-to-day requirements. You have a good enough annual income which takes care of all your expenses. So your ability to take risk is there, but you may not be willing to take risk. You may say, no matter what happens, I have this money that I want to invest, but I don't want to lose even a single penny, even for a single day. So that person has the ability to take risk, but he's completely unwilling to take risk. So risk is always driven by the ability and willingness to take risk. Liquidity of where you are investing is very, very important. So if you are investing in a bond or a debenture, especially corporate bonds or corporate debentures, even though they may be listed on the stock exchange, you may not be able to sell it whenever you want to. If you are investing in an FD, there are premature withdrawal penalties that you need to consider before you invest in an FD, right? So always consider the liquidity of the investment that you are investing in before you decide to invest in the same. And the last but not the least important thing is the tax impact. You also want to minimize what will be the tax liability on whatever returns you want to earn, and different investment assets have different tax implications. So please consider that before you start investing. So with that, let's go ahead. These are the basic asset classes that are available. So fixed income equity investments, real estate, commodities, as well as alternate investments. And over the next few slides, we will just do a deep dive into each one of these. Just give me a second to close this. Yes. So what are fixed income investments? So these are investments where the income or the interest that you get are predetermined and are fixed and do not change over the period of investment. So common examples are, fixed deposits, where you go to a bank or a company, a non-banking financial company like a Bajaj Finance or a Mahindra Finance or a Shriram Finance, where you give money 1 lakh for 3 years and you will get an 8% interest per annum. So the principal as well as the income is fixed. But does it mean that there is no risk with such investments? Of course, there are these risks that I have listed on my slide. The first risk is, of course, credit risk. The rate of return and the amount that you will get back at maturity are predetermined, but whether you will get it or not is a risk. It will depend on whether the company is solvent at that point of time. If they are solvent, if they have the ability to pay your income and your money back, then they will pay it to you. If not, then you will face what is called credit risk. And credit risk is determined by credit ratings, AAA being the highest credit rating for long-term investments and going lower down the order. The other risk that you face is inflation risk. If inflation goes up, if inflation suddenly reaches 7% or 7.5%, then you will find that your rate of return of 8% or 7.5% may just barely manage to save the real value of your investments. So you will face the risk of inflation moving up, especially. Liquidity risk is something that we have just discussed. And interest rate risk is something that many people do not really understand. But this is mainly applicable to fixed income instruments that are traded on the stock market or on some other exchange on a daily basis. Interest rates keep changing every day, especially when RBI makes its announcements, or if the government makes an announcement, the government announces its budget, or it announces, what are the tax collections or what are its capex plans. So these have an impact on interest rates, which keep going up and down, not really by a large amount, but some small amount here and there. It definitely changes on a daily basis, but this has an impact on the prices of fixed income investments. And especially when interest rates go up, then there will be a situation where the prices of fixed income investments go below the face value of the security. And that's when, if you go into the market to sell the security, you will see a capital loss happening on your investment. This is, of course, different from credit risk. It's not because the issuer is facing any kind of a challenge, but mainly because it's an economic issue that because of the changes in interest rates, the prices of securities will go up or down. So that is the risk that, and this is especially true for fixed income mutual funds, where you will find that even though the yield to maturity of some of the funds may be 8%, they may end up giving you a 5% or a 6% return in a year. And that's because if interest rates have moved up, then the prices of the securities invested by the scheme have gone down. And accordingly, it has had an impact on the returns of the scheme. The common examples of fixed income options is, of course, the government provides a lot of investments for Indian citizens, public provident fund, post office savings schemes, so on and so forth. Most of these schemes give a interest rate which is subsidized by the government, in the sense that it's a little higher compared to what the government generally borrows in the bond market. And that is why the government sort of caps the amount that each citizen can invest. Right. The other options for fixed income are, of course, the most common option that all of us just love to use is fixed deposits of banks and other companies, bonds and debentures issued by banks as well as other private sector companies, debt mutual funds. So if you do not want to get into the hassle of evaluating the credit ratings and the credit worthiness of each issuer, then uh, investing in a debt mutual fund, which is professionally managed, which is managed by fund managers who understand how to do credit analysis, review balance sheets, review industry sectors, they will take the decision to invest in the right kind of securities, look at interest rate risk, credit risk, liquidity risk, all of those risks, and manage your money for you. The last option is, of course, debt, PMS, and AIFs, which have now become more popular, especially for high net worth individuals as well as family offices. Let me just check whether there are any questions. So Swayam is asking a question as to how to deal with. Swayam, I will, let me come to the end of the presentation and then I will, you will get an answer to your question. Okay. So let's go to the next asset class, which is equity investments. In equity, when you buy an equity share of a company, you are actually becoming a part owner of the company, right? And as you might be aware, when you become an owner of a company, you are like the residual, you take all the residual risk in the sense that you are the last one to get paid, right? Everybody else gets paid first. The vendors get paid, the employees get paid, the government gets paid, the bank gets paid on their loans. And after that, if there is any profit that is remaining, then that is what belongs to the owners of the company, who are now the shareholders of the company. So there is no guaranteed return on the profits of any business. Therefore, the equity investments therefore are more riskier compared to fixed income investments. And the income that you will get as a shareholder will be in the form of dividend, which is paid out of the profits of the company. And if the shares are listed, most of the shares will be listed. Then if the profits of the company keep increasing every year, then the share price of that company will also keep increasing in order to take cognizance of the fact that the profits are going up and people are expecting prices to go up. So these are the two ways in which you make money from having investments in equities. You will obviously expect, because you are taking a higher risk, because there is no guarantee on either the income or the principal, you will only invest in equity if you are going to get a return higher than what you will get from fixed income investments. If you are going to get the same return as a fixed income investment, that is 7-8%, you would rather invest in fixed income. Why will you take the additional risk without additional return? So the fundamental principle of finance is higher the risk, higher the return. If you are going to invest even in debt, the same principle applies. If you are giving money to the government for 10 years, the government will pay you an interest rate of 6.7%. But if you are giving money to a non-banking finance company for a shorter period of time, they will pay you an 8% rate of return. If the finance company is going to give you a 6.8% return, then you are better off in taking lower risk by investing in a GSEC, because the government is unlikely to default. They have a sovereign rating. They have the ability to raise taxes. They have the ability to raise direct taxes and indirect taxes like GST, and increase their income and repay whatever debt they have raised from the public. So therefore, higher the risk, higher the return. It is applicable not only to debt, it is applicable to equity generally as an asset class, but even within equity, there are certain companies which are less risky and there are certain companies which are more risky. We spoke a lot about the Tata Group. It is one of the largest groups in the country. You do not expect the Tata Group to go bankrupt over a short period of time or ever, and therefore you are happy investing in the shares of their companies. They are considered to be less risky compared to, let's say, a startup which has just come in and which is listing its shares. So when you are investing in the shares of the startup, maybe you are doing it in the hope of getting a 15% plus return, but in the shares of a Tata Group or other large groups like the Birla Group or HDFC or Mahindras or Bajaj's, you will be happy with a 12 to 13% kind of a return, right? So in all the asset classes, higher the risk, higher the return is a basic principle that needs to be kept in mind. So moving forward to what are the equity investment options? Of course, you can go and buy the shares directly. You can open a account with a broker, have a demat account, and go and buy shares directly. But that requires a lot of research. Of course, if you should not be depending on tips from your friends and family and other people, or even nowadays on WhatsApp groups and other Telegram channels. You should really be looking at license providers who are regulated by SEBI. You should only look at those for either advice or for investing. So if you want the proper kind of advice, you should uh, sign up with SEBI registered intermediaries like a research analyst or a registered investment advisor or an AMFI registered mutual fund advisor, with those kind of people to get good advice. Or you can directly invest with equity mutual funds who are again regulated by SEBI, who are licensed by SEBI to offer these schemes, and the chances of fraud happening or any such issues happening are very, very low. Of course, that doesn't mean that you are not exposed to market risk, or those risks are still to be borne by you, but you will do well to invest in these kind of registered and licensed entities to ensure that your wealth and your assets are well taken care of. The other options are, of course, equity, PMS, and AIFs. Again, licensed and regulated entities. PMS, you need a minimum amount of 50 lakhs to invest, and in AIFs, it is almost a crore. So again, there are if you have 5,000 rupees, you go to a equity mutual fund. If you have 50 lakhs, you can go to a PMS, but it's something you have the choice of sticking to a mutual fund or to a PMS and then going to a AIF. Diversification is very, very important. This is actually one of the questions that is asked in that financial literacy survey. A long time back, Enron was a US energy company which couldn't do anything wrong, and it was falsifying its books to ensure that it kept reporting higher and higher profits. But at some point of time, it was realized that they were not doing the right things, and they had to declare bankruptcy. However, the relevant story here is that all the employees of Enron had also invested their wealth in the shares of Enron. So when Enron went bust, not only did they lose their jobs, but they also lost a majority of their wealth. So if they had invested in a diversified set of shares, then they would have not met that kind of a fate. And the last point here that is don't buy the market, in the sense that don't buy so many shares or don't buy so many mutual funds that you will get a return that is equal to what you will get from the market. You have to have a balanced portfolio with maybe 40 to 50 stocks or even lower than that, or maybe 1 or 2, 3 mutual funds in each category. There's no point in having 25, 30, 40 mutual fund schemes, because each mutual fund scheme itself is well diversified. A mutual fund scheme invest in 40 to 50 to 60 stocks. 50% of their portfolio or of their AUM is invested in the top 10 stocks, and the balance 50% is invested in a long tail of stocks. So just having 1 or 2 schemes is good enough. There were some reports that I saw recently which said that Indian households are investing almost 50% of their wealth in real estate. And this is maybe it's got to do with history, because in the 1970s, in the 1980s, there were no mutual fund, there was no PMS, there was no AIF, there were no private life insurance companies or general insurance companies. So the only choice that you had was to invest in real estate or in gold. And that's why you see that today, real estate still forms a major portion of the wealth of Indian households, followed by gold, and then coming down to fixed income instruments like fixed deposits. So fixed deposits have also been around for a long period of time. So again, that is we all like fixed deposits a lot. But one of the reports that I read is all of these 3 asset classes in the last few years, in the last 10 years, in many of the years, it has not been, the returns from these asset classes have not managed to beat inflation. So you're actually, not able to earn a real rate of return from investing in real estate, in debt, as well as in gold. But let me come back to real estate. So real estate is, of course, our biggest investment is in the houses that we live. But some of us are also able to invest in a second or a third residential property, which we can give it out on rent, or we invest in some shops or offices, which can be again leased out for commercial purposes. The income that you get from real estate is rental income. That is, if you lease it out, most people don't even do that. And therefore, they let go of that rental income. Rental income as a yield of current real estate market values ranges between 2.5 to 4% in different parts of the country, right? So by investing in real estate, your rental yield will be around 2.4 to 2.2 to around 4%. We always believe that real estate has done well for us in the past. And that's because we look at the change in the values of real estate over a very, very long period of time. So people will say, अरे 1980s में मैंने ये property खरीदी थी, तो 2024 में 10 lakh has become 5 crores or 10 crores. But if you really convert the growth of that amount in terms of CAGR over these years, you will find that very few of them have actually beaten what equities have done over this long period of time. Okay. So what are the risks with real estate? Real estate is very, very chunky. You can't buy something for 50,000 or 5 lakhs or 10 lakhs or 15 lakhs. In a city like Mumbai, you will probably need anything above 1 crore to buy a decent size house. And I'm sure it is the same for most metros. So you will need 30, 40, 50 lakhs. And, it's going to be a very concentrated kind of an investment, because if something happens there, your entire wealth is going to be exposed to that. The other thing is that it's not a very transparent market. It's not something that you can see the price every day. You cannot even convert it into cash very, very quickly. People always struggle to sell their real estate. Sometimes it takes months, sometimes it takes even years to convert real estate into cash. I'm just going to take a pause here and see if there are any comments here. Stable Nifty companies, real estate is okay. There are no questions here, so I'm just going to continue. The options to invest in real estate is you can just go ahead and buy the property directly, buy a house or buy an office. Or now the other option that has come up is you have these real estate investment trusts, which are nothing but mutual funds which only invest in house properties or rental properties like office spaces. They buy those properties, then they will give it out on rent, and they will after some point of time will sell it, and they will return the money to you. So the good thing is that you don't need a really high amount to invest in this kind of trust. Plus, the investment is diversified. It is over different kinds of properties in different geographies. So it's not that you're taking an exposure to just one property in Mumbai or Delhi or Pune or wherever else. The other asset class, the fourth asset class that we can discuss is commodity investments. Gold and silver is of course the most common. Gold is of course amongst both of them. Gold is the most common. Indians are importing, as a nation, we import almost 800 to 1,000 tons of gold every year, which is then converted into jewelry, and we use it for weddings, as jewelry or as bullion or gold or coins or bars or stuff like that. And again, people will say, oh, when I got married 25 years ago, the price of gold was 5,000 rupees, or when my grandfather bought it, it was 500 rupees. So again, if you really see the CAGR of gold, it will probably be in single digits, and none of it would have beaten what the equity markets have done over a long period of time. So these are the liquidity is very good. When it comes to gold, you can easily liquidate your holdings in gold by just walking into any decent shop. Of course, the quality of gold is going to be very, very important, and the issues on quality is something that we have all read about. The government has issued these sovereign gold bonds where they have recognized that Indians have this penchant for gold, and it is better off if the gold is if that those funds are handed over to the government, and they can make use of it by investing in other productive assets. So the government did issue a lot of sovereign gold bonds where they issued these bonds at the current price of gold, and you would not only get an interest of 2.5% per annum every year, but after 8 years you would get the current price of gold at that point of time, and therefore you would get the exposure of gold plus the interest, right? So these are the different avenues available for investment in gold. So how do you really decide, how much should you invest in gold? How much should you invest in property or equities or in debt? And again, it comes back to what is your financial plan? What is your need? Do you need, what is the rate of return you need, right? If you need a rate of return which is between 8 to 10%, that an asset allocation to equities, gold, fixed income will be adequate. Then you have to determine what is the liquidity of all these asset classes. What is the risk that you are willing to take? What is the tax implications of all of them? But if you need a return of 14%, then again, within equity, whether you want to invest in large cap or mid cap, you will have to allocate 60% to maybe large cap, 40% to mid cap. So again, how much to invest in which asset class will be driven by what your financial goals are, what is the time frame that you are looking at, what is your ability and willingness to take risk, right? These are the asset class returns over the last 10 years for 2023 and before. And as you can see, different asset classes have given different returns. You small caps are it's a very volatile asset class, and you can see either it is in the it's at the very top or at the very bottom. Large cap corporate bonds are somewhere in the middle. Real estate is somewhere in the middle, giving a return between low single digits only. T-bills, bonds are also somewhere in the middle. So this is why you should, if you invest in different asset classes, it actually reduces your portfolio risk, right? So if something has gone down, then some other asset class has performed better, and therefore your overall portfolio return will not be impacted so much. And in investments, when we talk about risk, we are talking about what is the volatility of your annual returns. How is your annual return very volatile? In the sense, if you look at small cap, right? In 2023, the return was 44.9. In 2022, it was minus 1.8. Then in 2020 and 21, again, it was very positive, and then negative in the last 2 years. So the volatility of the returns of small caps is very high. Okay, but if you look at corporate bonds, the returns will range between 4 to 12%. So the range of returns is what really drives risk. The higher the range, the riskier is the asset class. Okay, and therefore you need a much more longer time horizon when you're investing in the more riskier asset classes, because they will only give you a higher average return over a long period of time. Okay, you cannot invest in a small cap or a mid cap for 1 year or 2 years or 3 years. You need to have a 7+ year time horizon. For equities, generally, you need to have a time horizon which is more than 3 to 5 years. If you have a time horizon of 1 year or 2 years or 3 years, then you're better off investing in fixed income and gold rather than in equities. If you go to the next slide, this tells you the range, how each asset class has performed in each calendar year over the last 10 years. And the bottom part of the table tells you the 10-year average return over the last 10 years. So you can see that the 5 rightmost columns have given a return of between 6 to 8% to 6 to 9%, whereas credit risk fund has given 9% on an average, but the liquid fund has given 6.6% on an average. And again, sorry, I'm not able to see these numbers. Yeah. So these 14% is the Nifty 50 return. I can't see the mid cap and small cap numbers. Let me just move this. Yeah, I think that should work. Yeah. So mid cap has given a 22% return. Small cap has given a 20.2% return. But remember, these are actually average returns over the last 10 years. And if you see the calendar year returns, the numbers are actually the ranks. So you can see that small cap has given the lowest return in almost 5 out of the 10 years. So in 4 out of the 10 years, it has given the topmost return, but in 5 out of the 10 years, it has given the lowest return. So you should be prepared for this kind of volatility. You should be prepared that if in 1 year it has given 49% return, then in the next year it is probably going to give a negative return or a low single digit return. If you cannot stomach that volatility, then small cap as an asset class is not for you. You should then stick to maybe a Nifty 50 or a debt as an asset class. Now we talk about the power of compounding. Okay, these are some numbers. We looked at the inflation numbers, how the inflation keeps growing. So 5 lakh If inflation is at 7% and if you have an expenditure of 5 lakhs, then after 20 years, that amount is going to become 20 lakhs. But if you want to beat inflation, and if you invest in equities or any asset class which gives you an average of 12% return over a long period of time, then you can comfortably beat a 7% inflation rate because your 5 lakhs will generate a wealth of 48 lakhs. And see what happens if you just stay invested for 5 more years, 25 years and 30 years, the amount starts really jumping. And this is actually the magic of the power of compounding. And if you bring your attention to the column where the rate of return is 15%, again, you will see how the amounts are so much higher compared to the rate of 12%, and again compared to if you stay invested for a long period of time. They say Warren Buffett has made a lot of money. He's been one of the richest people in the world. But all he has done is he has stayed invested in equities as an asset class for almost 80 years, right? If you had invested 5 lakhs, and if you can just take this 30 years and add 50 more years, you can imagine what will happen to this 3 crore 30 lakh. Because imagine 3 crore 30 lakhs every year. In the 31st year, it will become 3 crore 75 lakhs. Why? Because 15% of 3 crore and 3 crores will be almost 50 lakhs. So it will become 3.8 crores. So if you add another 50, all you need to do is stay invested in an asset class for a very, very long period of time to really generate a lot of wealth. But if you think this is theory, I want to show that it is. I want to show you on the next slide that is actually happened in practice. So these are mutual fund schemes that are in existence in India today as we speak. And as you can see that they were launched in the mid-90s. If you had invested 5 lakhs at a 19.95%, at a 19.25% return today, that amount of 5 lakhs would have become 9 crores in HDFC FlexiCap scheme. If you had started a 10,000 monthly SIP from 1st Jan 1995, and if you had continuously kept investing 10,000 rupees every month, you would have invested an amount of 35.4 lakhs, which would have, the value of that 35.4 lakhs today would have been almost 20 crores. All you had to do was invest 10,000 rupees in one broadly diversified scheme for almost 29 years and stay invested. Okay. And that 25 years, 20 years and more, 15 years and more is where the actual power of compounding starts kicking in. Okay, what generally happens is we get happy when we get a multi-bagger of 2-3 times and we withdraw our money. We do not stay invested. If we stay invested, the power of compounding will then work its magic and really make you a lot of wealth over that kind of a period of time. Okay, I have spoken a lot about wealth. It's also almost 5 o'clock, so let me wrap up quickly. Insurance is very, very important. It's a risk mitigation tool. We face the risk of losing the main income earner of a household. We are investing in assets like our house, our vehicle and appliances. Anything can happen. Climate change is occurring all over the world. A lot of typhoons, floods, droughts, all of those kinds of things are happening, which can easily impact all our assets. So taking the adequate amount of life insurance cover for the main income earner, taking the adequate amount of insurance for all our assets is very, very important. Do not buy insurance for tax benefits or for getting a return. Insurance is a risk management tool, so you should always ensure that you buy a life cover which is 10 to 15 times your annual income. And as and when you review it every 10 years so that you ensure that you are adequately covered at all points of time. Add AD&D covers to it. Have adequate health insurance policies of your own, in addition to what your employer may be providing to you. When it comes to debt, there is good debt and there is bad debt. Good debt is where you take a debt to for your education, so you are earning your earning capacity, so that's good debt. You are taking a loan to buy an asset which is going to appreciate in value, so a real estate like a house or an office. Some of those things you can invest in by taking a loan over a long period of time, of course, but do not speculate. So those are examples of good debt. Bad debts or examples where you should not be taking debt is where things like buying a vehicle or a consumer durable, because these assets depreciate in value and you will end up paying a higher amount for that appliance. So it's always better to invest, save and invest, and then buy these appliances. And of course, the ugly part of debt is taking personal loans or credit card debt, which comes at a very, very high cost. So last but not the least, prepare a budget, save and invest at least 25% of your gross income, determine your goals, consult a licensed financial advisor, a mutual fund distributor, or an insurance agent or an RIA to prepare an investment plan. Invest in accordance with the requirements of your plan. Review all your investment policies for adequacy of risk coverage. Optimize your tax investments. Ensure an emergency corpus of at least 3 to 6 months of your expenses. Make sure that they are in a liquid fund or an FD. Review all your loans, high cost loans, pay them off first before you start investing, and ensure that you review your budgets and your investments at least once a year, if not more frequently. So I think with that, we come to an end on this presentation on building wealth. Srinivas, over to you.
Thank you, Sanjay. That was a very insightful presentation, and I can see that a lot of folks were really engaged, and there's almost 240 participants. So it was very, very insightful. Thank you so much. I would thank Mr. Kunj Bansal, Mr. Amir Sayed, the director, Mr. Sashi Krishnan, and the entire NISM family to NISM firm to have us and collaborate this event on this very important day and important the Global Ethics Day and the important week, the Investor Week, to be able to share some of the ethical principles as well as the basics of wealth building. Thank you again. Thank you, Kunj. That's all from now from my side. Have a nice evening. I think we are done, Sanjay.
Okay, thank you all.
Thank you.